This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. I have probably the most important question to ask Taylor today. How you doing, buddy?
You're going to ask the most important question to the least important person? Who does that?
Your words, not mine. I would never say that. I might think it, but I would never say that.
Burn, baby, burn.
Oh, ouch, ouch. Get some aloe vera. Anyways, what I wanted to ask you is, we've kind of hinted at it a couple of times, right? The Fed, I've said publicly, the Fed broke housing. I'm now saying the Fed broke the economy. Well, you fix the economy by eventually flip-flopping or pivoting or cutting rates or whatever your analogy is. So I'm just curious, if you were to just look in your broken crystal ball, what are some signs or things you think that would cause the Fed to maybe pause first and ultimately start cutting? Is it a metric? Is it a thing? Is it a time? I have my thoughts, but you're the guest. I'll let you go first.
Yeah, I think that what it comes down to is always listening to what Jay Powell says in interviews afterwards, because that is where people are able to pull things out of him that maybe he doesn't want to say or doesn't want to say in formal comments. So I think you get you glean the most off of his off the cuff remarks more than his prepared, I'm going to write these out, everyone's going to go through it. So I think what you'll be able to start to see at some point is him start to talk more about the economy than inflation. And right now, we're just not there. Enemy number one, by all means, is inflation. And we talked about the fact that it's a regressive tax. The people who can least afford it, disproportionately pay it the most. The poor people pay the same amount for gas as the rich people, and it takes so much more of their paycheck to get there. So they need to get inflation under control. But I think what you'll start to see is, if and when it will eventually start to curb, inflation will come down, and the economic news at that point will have been poor, in my opinion, for a period of time. And the conversation will go from inflation getting under control to here's where we're at from an economic standpoint, and here's what we're looking at. And it's not pretty.
Yeah. So let me ask it this way, because I certainly have my thoughts and I'll share them regardless of how you answer it. Do you think there's any chance that the Fed pauses or cuts this year?
Yes. Yep. And
really?
and that's something that I've said, and I know I assume yours is a disagreement here, but that's fine.
Yeah.
And I've said this before, that I thought that rates wouldn't be able to be raised as much as what you thought they were before the Fed really breaks the economy and then has to reassess. And I think one of the other things that I believe that maybe you feel a little differently on is the fact that the Fed has a dual mandate. And this is just the fact. So the dual mandate is price stability, inflation, and full employment, or what they refer to as full employment, where we're at right now. I also think that GDP is a big factor in that, whether it's a stated mandate or not. It's not stated in their mandate. But I think if they see the economy start to wither, that has got to be something that they react to, and has been in the past something they react to. And tertiary, or whatever the one beyond tertiary is, the fourth iteration out, they do pay attention to the stock market too. And we're not there yet. Like, we're down 20, right? That's, in their opinion, look where we just came from. We've given you guys all this money. We've given you all these returns in the stock market. That's a function of what they've done. They're certainly not ready to pivot at 20% by any stretch of the imagination. But as they continue to raise rates to curb inflation, economy is going to get worse. The stock market's going to get worse. And I think that at some point that pivot happens. And I actually do think that pivot happens this year sometime. So you're going to get the next upcoming one in July. Is going to be, now it looks to be almost a foregone conclusion at 75 basis points. You probably get, I thought they would stop there. So full disclosure, looking back at the beginning of the year, this is where I thought they would get to. Now, I got to imagine September, there's 50 to 75 on the table. And that's where I think that the economic data at that point is weak enough where they start to go.
Okay. I could see that. I absolutely could see that. And I suspect most people in the market probably agree with you that there's certainly at a minimum a pause, right? Where there's one meeting this year where they do nothing. Right. That's where you are. I'm in the camp of, I think we get a raise something every meeting. I think there's 4 meetings left, including July. I think you're right. July's at 4
July,
now.
September, November, December. Correct.
Yeah. So there's 4 left. I think you get something. I think at best you get a 25 in December. So I think there's a rate rise. I think the first pause is the first meeting in 2023.
Yep.
Again, as they've proven, right, very much kind of looking in the rearview mirror. I think the next 3 months, if you stare at the base effect, they're actually very marginal moves, which kind of, right, the next big jump is 4 months out, which again gets us to that December timeframe. So December, I'm not very confident on, but I'm gonna stay where I'm at, where we will get a rate rise, a Fed funds rate rise at every meeting going forward. Folks, if you're listening to this, let me know what you think. Do you think we get a pause this year? Are you in the camp with Taylor, or do you think we get something at every meeting, the next 4 meetings going forward? Love to hear what you have to say. But now the big question: when do they cut? Right. So you think a pause is this year. I'm going to guess you don't think a cut is this year. When do you think they cut?
I don't. So I don't foresee a cut happening this year. But there is, in my opinion, it would be tough. It would be tough to cut this year. The economic data, if it comes in and we're in a recession right now, which we'll know in July, backward looking that we're in a recession. If there's a contraction in the third quarter as well, then that starts, and obviously the severity of that contraction. And again, this is all barring my thought that, again, if we get a negative next quarter, that means we're in a recession. If it goes further negative in Q3, that would then start to call into question, okay, certainly in my opinion, we pause at that point. Okay. Again, this is not part of their mandate, but I think it's very important to them, whether the economy is expanding or contracting. We're talking about a contracting here. And if it does shrink for 3 quarters in a row, I think they then have to say, okay, what are we going to do here? I don't think you get a cut this year. It's really tough to think about cuts as we're raising at 75 basis points. Usually the pendulum doesn't swing that quickly. So I think it does extend out into 2023. But this is more the scenario that you laid out earlier this year than the one that I laid out, where they are able to raise too much, in my opinion. And that's kind of what we're seeing. I thought that things would start to break more quickly and then it would start to show through in the economic data. It might be, but it's still, the inflation print is too persistent.
And it's not trending down, right? We don't have those
no,
two data points.
not at all. Yeah, we have not controlled it, right?
Yeah.
So and you know, a lot of things at fault there. Supply chains at fault there. COVID's at fault there. The Fed rating money's at fault there. The Russian invasion of Ukraine's at fault there. There's a confluence of different things coming together there. And the persistently high oil prices that we see are a drain on the economy. They are a tax, and especially a tax to lower end of the economy, which is very tough. They're the ones that they're the ones that drive the discretionary spending, is the lower end of the economy.
Agreed. Yeah. When I look at this situation, even if we had 3 or 4 quarters of negative GDP growth, but let's call it all sub 2%, negative 0.5, negative 1.1. If we're in those range, I don't think that causes the Fed to cut. I actually think the Fed starts to think about cutting when unemployment gets to 6%. That's the number, right? And it goes back to their dual mandate. It's either A or B, depending on what you want to look at it. And right now with 3.6%, we have 1.9 million openings. Even if that number's off, we still have lots of openings for the unemployed. I think, again, the Fed talked about they see unemployment potentially going over 4. I think they're living in fantasy land. I think it's going to race to over 4, get over 5. And if it ever got a 6 handle, that's where I think they seriously talk about cutting.
It's funny because there's so many open jobs right now, and yet you're starting to see, like, how quickly does this number change? Because with all those job openings, we are starting to get layoff talks from a lot of different industries right now. We are. So do those people just rotate into these other jobs, or is it more of a stuck, and the people that are getting laid off are not qualified or are not interested in the jobs on the other end, and therefore you see the unemployment tick up? I tend to think that's probably the case, the latter of the two there, where they don't just switch their jobs and move over here and take whatever job it is available. I think that people are going to probably have to get trained if they're going to switch, whatever it is. I just think that it's a slow progression from someone getting laid off on this side to likely switching industries and taking a job where the jobs are available. People don't show the willingness to do that very quickly.
No. And that's the number I'm watching, right? If you were to ask me what number I'm watching to see a pause, and then ultimately a cut. It is the second part of their dual mandates unemployment. I think it's going to rise much faster than the Fed thinks. I laughed when I saw the dot plot that they think unemployment's going to go to 4.1. I laughed out loud.
Yeah.
I'm like,
yeah.
What are you talking about?
What's that? They're extremely, and they say this all the time. We're data dependent. We're data dependent. We're data dependent. What data dependent says is you look in the rear view. To your point, like you have to use those rear view mirror indicators to create what you think the story is moving forward. And you can't just be relying upon the backward looking stuff.
Yeah, I couldn't agree more. Any other closing thoughts on the Fed, when they're going to pivot, what's coming, and as we wrap this up?
No, you have drawn me further in your direction, which is great. You've been spot on. So we'll see if I can draw you back in my direction and they have to pause a little sooner than what you think.
Yeah, we'll see. Again, I'm calling for no. There will not be a pause this year. I think the first meeting next year is the pause. No chance of a cut this year. That would be.
Yeah.
I think a cut this year sends the market into a tailspin because then the Fed doesn't have any control. And
it very well could. I don't think there's a cut this year either, but I do think there's a pause this year.
Awesome. I love this because again, we can in a few months we'll look at it and see what's what. So Taylor, where can people find you?
Yeah, you can find us at Life Goal Investments on Instagram.
Awesome, buddy. I appreciate your time. Thanks again.
You're the man, Michael. Thank you.
Thank you.